Hi, everybody. My name is Zhen Rong. Today, I will be talking about the vertical analysis of financial statement for Tiger Company and the Lion Company based on their 2024 finance state. Vertical analysis, also known as a common size analysis, allows us to compare companies of different size by converting each line items into a percentage. For the income statement, everything is shown as a percentage of sales. For the balance sheet, each item is shown as a percentage of total assets. So let's start with the income statement. We calculate each item percentage based on sales. For example, Tiger's cost of goods sold was 73.87% of its sales, while Lion's were slightly lower at 71.94%. Lion also had a slightly higher gross profit and a net profit after tax, 9.25% compared to Tiger's 8.6%. This shows that Lion was a bit more profitable in 2024. So in balance sheets, Lion had more cash and higher retained earnings as percentage of total assets, 7.93% and 28.04%, respectively. Tigers, on the other hand, had a higher percentage of accounts receivable and inventories, which may mean slower cash conversions. To sum up, vertical analysis help us understand not just the size, but the structure of each companies. Land company appears stronger in profitability and equity positions, while both frames show similar costs and asset profits. That is my part. Thank you.
Hi everybody, I'm Sumis Kumar and I'm here to talk about liquidity ratio and solvency ratio. So first, let me talk about liquidity ratio. Liquidity ratios are crucial because they measure a company's ability to handle short-term obligations. So in liquidity ratio, there are three types of liquidity ratio, and they are current ratio, quick ratio, and working capital ratio. In current ratio, it helps to assess company ability to cover current liabilities, and whereas in quick ratio, it measures the financial flexibility without relying on any inventory. And for working capital, it indicates available resources to meet financial commitments. So after that, I'm going to talk about solvency ratio. So solvency ratio examines a company's ability to sustain operations and manage long-term debt. And in solvency ratio, there are three ratios. There are debt ratios, debt to equity ratio, and time interest on. So first, let's talk about debt ratio. It compares the total assets to assess financial risks. And debt to equity ratio, it evaluates the financial leverages of company. And whereas time interest on, it indicates the company's ability to cover interest payments. So this is the table. This is the table which provides a snapshots of Tiger and Lion companies' liquidity and solvency ratios. Let's compare between Tiger and Lion company by using the previous calculation. Lion's low debt ratio and financial leverage make it safer long-term investment. Its stable financial structure ensures resilience even in slow economic conditions. However, Tiger has a stronger liquidity position, giving it better short-term financial flexibility. It relies more on debt financing, which increases the risk but also present growth opportunities. So thank you for this is all my time.
Hi, my name is Brinda, and today I'll be presenting a financial comparison between Tiger Company and Lion Company, focusing on their efficiency and profitability ratio for the year of 2024. I will just share my screen here. Sorry. Let's begin with the efficiency ratio, which measures how well each company is managing its assets and operations. So, starting with the accounts receivable turnover, Tiger has a turnover of 8.54, while Lion leads significantly with 12.16. This tells us that the Lion is collecting its receivable faster, reflecting a stronger cash flow management. Looking at days sale in receivable, which reflects on how many days it takes to collect payment, Tiger takes 43 days, while Lion it in just 30 days, again demonstrating a better efficiency. Next, we move on to inventory turnover. Tiger's turnover is 3, while Lion's is 6, meaning Lion is again turning its inventory over twice as fast as Tiger. This is confirmed by their days sale in inventory, 122 days for Tiger versus just 61 days for Lion. Lion is clearly managing its inventory more significantly. Finally, in total assets turnover, Tiger records 1.03, while Lion shows 1.48, including Lion, indicating that Lion is generating more sales per dollar of assets, a clear sign of superior asset utilization. Now let's move on to profitability. Starting with the gross profit margin, Tiger reports 26.18%, while Lion edges ahead of 28.09%, indicating slightly better cost control and pricing strategies. So in terms of net profit margin, which reflects how much profit is generated from each dollar of sales, Tiger is at 8.60, while Lion again outperforms at 9.25. Moving on to the return on total assets before tax, Tiger achieves 10.34%, while Lion reaches 16.39%. This shows the Lion is earning significantly more from its assets. Lastly, we evaluate return on equity. Tiger stands with 17.78, but Lion posts an impressive 23.69, reflecting better return on shareholders. So just in summary, while both the companies are performing exceptionally well, Lion Company consistently outperforms Tiger Company across all key efficiency and profitability metrics. So Lion is more efficient in managing receivable inventory and assets, and is also delivers a stronger return on both sales and equity through faster asset utilization, more effective inventory and receivable management, and higher margins and return. Lion showcases a stronger operational strategy and great value generation for stakeholders. That is my part for now, and for the rest of the assignment, I will hand it down to my colleagues. Thank you.
Hello, I'm Bowen Liu. Today I will talk about the market perspective. A company's market performance is critical for investors evaluating growth potential and risk. By analyzing key market ratios such as the price-to-earnings ratio and dividend yield, we are able to compare Tiger Company with the Lion Company to determine which offers better value. The first one is PE ratio. Tiger Company is 19.7 and the Lion Company is 13.7. The second one is dividend yield. Tiger Company is 6% and the Lion Company is 6%. The next section is financial evaluation. Financial health is a key indicator of company's stability, performance, and long-term viability. This report uses the 2024 financial statement of Tiger Company and Lion Company to assess them from 5 key aspects: liquidity, solvency, efficiency, profitability, and market perspective. The goal is to determine which company has a stronger financial situation and greater investment potential. From the summary table, we can see Tiger Company, the liquidity is 2.24, Lion Company is 2.14. Tiger Company's solvency is 0.92, Lion Company is 0.70. Tiger Company's efficiency is 3 point, and the Lion Company is 5.9. Tiger Company's profitability is 8.6, and the Lion Company is 9.2. Tiger Company's market value is 19.7 and the Lion Company is 13.7. This data provide a view of financial conditions of Tiger Company and Lion Company. Lion Company has strong solvency, high efficiency, strong profitability, and a more attractive valuation. Although Tiger Company has good liquidity and growth potential, Lion Company's overall financial health makes it a safer and more rewarding investment. Thank you so much for listening. My part is over.
Let's take a deeper look at the overall financial comparison between Lion and Tiger companies. We have analyzed both firms across key definitions: solvency, profitability, efficiency, and market valuation, and the results are quite telling. Starting with solvency, Lion's companies shows a much lower debt ratio and less financial leverage, which significantly reduces its long-term financial risks. In today's economic environment, this kind of conservative financial structure is an important indicator of sustainability and reliance. Profitability is another key where Lion excels. Its return on equity stands at 23.7% percent compared to the 17.8% for Tiger. That's a notable difference and indicates that Lion is using shareholder funds more efficiently to generate profit. Then there's efficiency. Lion has demonstrated superior assets and inventory turnover, meaning it's able to convert its resources into revenue more quickly. This reflects better internal management, operational discipline, and responsiveness to market demand. And finally, we looked at valuation. Lion's price to earning PE ratio is lower, meaning investors are paying less per unit of earnings, which makes it more attractive from an investment standpoint. Taken together, these factors can create a strong case for Lion Company being the better performer across the world. Which company is more investable? Of course, Lion. If we are looking purely at short-term liquidity, Tiger does responsibly well.
It has sufficient current and quick ratios and healthy working capital, which means it can handle its short-term obligation without too much trouble. But when we shift our focus to long-term financial health, Lion clearly pulls ahead. Its capital structure is more balanced, it takes on less debt, and it still maintains strong returns. This is exactly the kind of profile long-term investors look for. A company that is not only profitable but also financially sound and less exposed to risks. Additionally, from a market valuation standpoint, Alliance offer a better investor proposition. A lower PE ratio, as mentioned earlier, means you are getting more earnings for every dollar invested. Wh- When a company with strong earnings and good fundamentals is trading at the relatively lower valuation, that's typically seen as an undervalued investment opportunity, and that's exactly what we see with Lion. So when we bring together all five aspects of the financial analysis: liquidity, solvency, efficiency, profitability, and the market perspective, Lions comes out on the top in most. Conclusion: why Lions wins. Both companies have their own strength. Tiger Company shows decent liquidity and some potential for growth, particularly in short term. However, when we evaluate the companies from a holistic financial perspective, Lion emerges as the more complete and stable performer. It has a strong solvency backed by a low debt ratio. Its efficiency ratios are more favorable, indicating that it uses its assets more efficiently. It boasts high profitability. It's seen in the stronger return on equity, and its market metrics suggest that it's under undervalued relative to the performance, a very attractive quality for investor. So based on all the data and analysis we have presented, the answer is clear. Lion Company is the more investable option. Thank you for your all the attention. We hope this presentation have give you the valuable insight into the detailed financial analysis can support a smarter investment decision. Thank you.